Hello and welcome to this very special interview here on Money Paathshaala. Joining me today is an industry veteran, Sandeep Bagla, who's the CEO of Trust Mutual Fund, but that's only part of his life story. He has been at multiple places, seen India's financial markets very, very closely. Today, however, we are going to talk to him about debt mutual funds because Sandeep's firm, Trust Mutual Fund, which he heads, is solely focused on debt mutual funds. And there's been a lot of debate around whether debt mutual funds will even survive post the recent tax changes, which came up just before March 31st in the budget amendments. So let's try and understand that debt and debt mutual funds, how are they going to look in the future? And I couldn't think of anyone better than Sandeep, who has, taken the plunge to say that, look, we need to deepen India's fixed income market. And, we all talk about mutual funds as equity, but there's more to investing than just equity. It's always good to have an asset allocation. Sandeep, thank you very much for taking time out. My first question, which I think I've already asked, but how do you see pure debt mutual funds surviving or thriving from here on? What is your view?
Thanks, Vivek, for inviting me and giving me this opportunity to clarify on number of issues. Uh, you know, while there was a tax incentive for people who held debt mutual fund investments for more than 3 years, there is a large amount of investor money which comes in and goes and is not looking for the tax benefit. So if you look at corporate treasuries or the bank money or some of the high net worth individuals, they do not necessarily uh, wait for 3 years to stay invested. See, there's a big discussion that whether one should invest in FDs or one should put money in debt mutual funds. And my point of view has been that, it's not one versus the other. It is one and the other. While bank FD is safe, bank FD is slightly inflexible in the sense that, there could be a penalty when you take your money out. Also, a bank FD will give you a fixed interest rate return. On the other hand, a debt mutual fund, since it's open-ended, it gives you equal liquidity. Most of them are investing in extremely high-rated bonds, so it's as good as the safety, or maybe perhaps the better than the rating of the bank that you are investing in. And when interest rates come down, and they do come down periodically, then one can generate capital gains as well. So if you were to look for the last 3 months returns in most of the debt mutual funds, I think they would be in the range of 10 to 12% annualized. Now, you could say that, I would have got 7% or 7.5 on my bank fixed deposits. But here, there has been an opportunity where you got something like 10 to 12%. So there will be timely opportunities in mutual funds. And on the balance period of time, you will get the portfolio yield. So I think it's not a question of one versus the other. I think both are good supplements to each other. They are complementary. And while the wealth community might hesitate to allocate funds to debt mutual funds initially because of the lack of tax benefits, I think some of them are coming around as they are seeing the merits of debt mutual funds, which are beyond the tax benefits.
Is one of the benefits, that you mentioned briefly, and I want you to elaborate on that. You made the point about, HNIs still finding this attractive. And if you look at our Indian capital markets, maybe it's the world over, but at least one can talk of India, that it's always been the corporates, the HNIs who enter first. So even when we, had online trading, it was them who really came in. DMAT happened, it was them who came in first. And then the retail followed. If you are saying that even post 31st March, HNIs, corporate treasuries are still seeing value in debt funds, then do you feel it's a matter of time that retail will also see the value, and I think it's more of an education issue, isn't it? I mean, vis-a-vis equity, where a lot of education has happened, much lesser has happened on the debt fund side. For an individual to understand that how can I get these good yields, how does the interest rate cycle affect my returns, which probably a corporate or an HNI, because they have a team of people, they do understand this. But the point you made about capital gains, the fact that in an FD, I get that interest accrued to me every year and I pay tax on it if I'm in the tax bracket. Whereas here in a mutual fund, if I hold it for 10, 15, 20 years, I'm only going to pay the tax at the time of redeeming. I mean, is that a benefit? I mean, what are your teams who are going out and trying to convince retail investors? What are they telling them? Why should you still be in a debt mutual fund?
So there are multiple questions in your question. One, let me clarify that after from April, mutual fund debt schemes have seen only inflows and substantial inflows. So it's not that there has been any outflows because of lack of the tax benefits. I don't remember the numbers, but I think close to about 1 lakh crores would have come in at least in the mutual fund industry in fixed income markets. Secondly, yes, you made a good point that initial drivers of any change is typically the corporate world, which can analyze things better and faster, and the HNI community, which is perhaps guided by the wealth managers and their own analytical teams. So, debt has always been a part of the allocation of the individual investor without them knowing it. So, for example, when you put money in insurance companies, you are indirectly putting money in debt. When you are putting a bank FD is nothing but debt. The only thing you don't know is because you are not holding the paper in your hand and you are not seeing the fluctuation in the underlying prices on a daily basis. So, you're not really aware of it.
Mm.
In this case, since you have a daily mark to market, you have a return, you are able to see the way things are moving. Now, we had done a small analysis about 3, 4 months back when we saw that the returns on, let's say, a Crystal Bond index had come to about 8.75% in the last 15 years. So it is not that returns have not come. They have been choppy because the interest rate environment has been choppy globally. We have seen 2, 3 crises, and sometimes the inflation surges. And the more the intervention of the central bank, the more volatile the interest rates get. Now, this is something which the retail investor cannot wrap his head around, and which is why mutual funds or the distributors have not really spent too much time trying to explain that, because the greater distributor the distributor earns a greater amount in pushing fixed equity products. The debt part is taken care by other products, which are not mutual funds, and sometimes by direct bonds as well.
Mm.
Now, I think going forward, when you see that there are no upfront commissions to be paid to distributors, the TERs are coming down, there's only trail fees, and people will realize that to bring in stability in the portfolio value, you require a component of debt. I think mutual fund distributors will soon start, advocating fixed income products as well.
Mm.
So it's a combination of various factors, which I think initially they might look not so great, but I think eventually it will lead to a more widely dispersed and well allocated portfolios, which do well in most circumstances. Because typically the benefit of debt is that when the economy does badly, debt performs because central banks tend to keep monetary conditions light and they ease the monetary conditions. And typically at that time, equity markets might not be doing well because the outlook on economic growth is not good. So it's a very good hedge for the portfolio from a portfolio perspective, that when your equity is not doing, your debt is performing. When your debt is just giving you the coupon rates or slightly lower than that, then your equity is performing.
Mm.
So one has to find an optimal balance between debt and equity allocation. Currently, as a country, we are all return chasers. We try to chase the highest returns, and equity markets have been performing very well and have served the purpose of returns well for mutual fund investors. And which is why the focus on debt has been low. But I think going forward, there will be better sense, and people will try to sell both the products.
Hmm. Hmm.
And of course, we have another extremely good example that you pay tax only when you redeem from the mutual funds, while in FDs you accrue the coupon or the interest rate on a daily basis, and you have to pay tax periodically every year.
Hmm.
So that itself is a good advantage. You can push your tax liability to a much longer period, and that could also lead to a longer duration of holding from mutual fund investors.
Hmm.
So yes, there are benefits. There are definitely diversification benefits, hedging benefits, possibility of higher returns, possibility of tax being paid later. So in fact, you have highlighted some of the very good pluses of the debt mutual funds.
So, a couple of questions here, Sandeep, for you. One is, you and your promoters chose to be a debt focused fund. And I'm sure, knowing the kind of pedigree and experience you all have, I'm sure you didn't make that decision based on some tax benefit. So, there must have
Of
been
course.
something much larger as a game plan to be focused purely on debt. So that might be another way, if you can explain that, to understand why debt still remain, or debt mutual funds still remain relevant. And my second question, that if it is about asset allocation, and again, this is coming from the commentary that one is hearing, that probably, say, a balanced advantage fund, which has a dose of equity, a dose of debt, might also serve the purpose that you talked about, that I would have some amount of debt in my corpus, some amount of equity, and yet get the tax benefit. How would you react to these 2 points?
See, on the first point, we have entered the mutual fund industry with a very, very long term horizon, maybe 30, 40 years, that kind of a view. So it was not by some great intent that we said that we will launch debt first. It was just a matter of deciding what to launch first, and it just happened to be fixed income. We have a very good pedigree in equity investments also. We have equity PMSs which are doing extremely well. So we intend to launch equity in this financial year, and probably hybrid funds as well. So while we started with fixed income products, but we are not going to remain a pure fixed income house for long.
Okay.
Uh, the other question was that whether balanced funds would serve a good purpose. See, balanced funds, of course, have gained a lot of traction in the last few years, and couple of things I would like to say. One can create a synthetic balance fund on your own and probably save a few basis points on the fees. That could be a situation. Of course, there are now dynamic balance advantage kind of funds which try to manage based on valuations. So yes, that is a good option, no doubt. And however, when you have to withdraw the money, you will have to withdraw across the asset. So that doesn't allow you to sort of rebalance at your end, and you are left to the fund manager's timing as to when he wants to increase the equity and when he wants to decrease the equity component. So
Hmm.
of course, the balance advantage funds are very good for slightly more long-term investors. But if people want to have some control over their own asset allocation, then perhaps you could do it with the combination of pure investment into pure equity funds and investment in debt funds separately. And perhaps you could save some few basis points in terms of the cost that you incur.
For young people, new investors, Sandeep, who are probably earning less than 7 lakh, and now that the government has been very clearly year after year signaling that, look, there is one tax regime where there are no deductions, but we'll give you a higher limit, invest on your own. And there is another old regime where we still give you some benefits, but you'll have to pay a higher tax. So for somebody, say, who's earning 7 lakh, has just about start or wants to start investing, and does not have the experience of understanding a market or mark to market kind of a product, which is, going to see volatility of its own, of course, much less in debt, but still there. Would you say that that is a category that probably should wet their feet with a good debt fund, which has liquidity, meets their short term goals, which a lot of young people have, right? I want to buy a gadget, I want to buy a bike, I want to buy a car in the first 3, 4 years of my working life. And these are not goals for which you should put your money into equity anyway.
See, it completely depends on the personal, risk appetite. I have seen some large equity fund managers, who invest only in liquid funds. I have known liquid fund managers who invest only in small cap funds. So what you do and where you invest depends completely on your risk profile. And same goes for the investors also. But since you are talking about the younger investors, I would recommend that, maybe put 30% in bank FDs, put 40% in equities, and maybe put 30% in debt funds. So choose just three funds, maybe across AMCs or maybe from the same AMC, and just keep putting money there.
Hmm.
Because bank FD definitely give you certain return even irrespective of interest rate cyclicity, right? Equity should gain because if you are saving for 4 5 years, then uh, the growth story should continue, global growth story and India's growth story. And anyway, you have the huge amount of liquidity surplus in the global system, which is pushing up asset prices. Even if the things go wrong, you will go wrong only on 40% of your investment, and
Hmm.
then probably the debt will do well. So I am saying that divide the money by and large equally across three products. One
Hmm.
where there's a possibility of capital gains hedging your equity markets, and FD giving you straight interest rates. So absolutely, it should be a good combination for them.
One final question, Sandeep. We've seen two, RBI cycle pauses, if I may say so. And, while the market has been building up expectations of rate cuts, we haven't seen that yet, but at least, the continuous rate hikes, at least, now for two policies have been on pause. What is your outlook going forward, you and your research team? And therefore, like there are a lot of experts who are saying that, look, sooner or later, with inflation coming under control, we might see, rate cuts. And that is a good opportunity for you to lock in your money right now to get the benefits of the yields as of today. So, what is your outlook for the next, say, 1 year or 2 years? 1 year may be fine because it's not something you can predict for a long time. But what is your view?
So I think that for the next 6 months, the outlook is slightly mixed. And why I say that is because initially during COVID times we had super easy rates globally and in India, which were artificially low to support growth during COVID times when life came to a standstill. However, now the economic growth has been very strong in India and in the US. Unemployment rates are low. So labor markets are extremely tight. There is a danger of wage inflation spiral where wages increase, leading to inflation, leading to wages increasing, which are linked to inflation. So there's this possible spiral building up, and which is why the central banks are cautious right now. They are aware of the transmissions lags which can take place, and they are hoping for some data to improve. and which is why they're on a pause mode. But a pause mode, I think, should not be interpreted as a rate cut immediately. There could be long pauses, or there could be, in exceptional circumstances, a hike after a pause.
Hmm.
So it depends on, which way, if the labor market does not give in, if inflation again tries to go up, if the commodity prices go up. So I think it's a wait and watch. So for the next 6 months, I would say that recommend that do not take too much duration risk right now. Just wait for it to play out and then probably add to duration. So from an investor perspective, I would say something like a short-term fund or a money market fund should do well. 20% probably you could invest into income fund kind of schemes or guild schemes, which can perform well during if interest rates were to be cut. But the current perception and the current estimate and analysis seems to show that cuts might be far away from where the market thought they would be.
Hmm.
So the rate cuts are getting pushed, and one needs to take a fresh view of where the data is coming from and what the interpretation and the reaction function of the central banks will be. So right now it's a pause on interest rate calls. We have moved from 7.5 to 7%, and I don't see any upside in bonds in terms of interest rate cuts or price appreciation anytime soon. So we'll have to watch this space for another 3 to 6 months.
Always a pleasure talking to you, Sandeep. Thank you so much for coming by and clarifying so many things. India needs, and Indian retail investors need a deep uh, debt market as well, just like we've created a strong equity market. And I wish you all the best in your efforts in doing that. Thank you very much for coming by.
Thank you. Thank you. Thank you so much, Vivek. Thanks for having me.